Okay, reviewing SunPower by request. Somebody that knows the industry wants to know how they play it on the long side. Just a side note, Circuit City just got a bid from Tesla. At least the news just came out. I think it's up 20 or 25% after hours. Tesla is down 6 or 7% on the news. Okay, so back to SunPower. I don't know the fundamentals. I know that the technicals are not that great. It made a round trip from forever. You know, the highs and the lows are so far apart, so it's somewhere in no man's land now. I think there's a period of time where it jumped from 10 to almost 20 in like 3 weeks. And let me see if I can show you a visual of that. Right there. Right there. That is Circuit City. I mean, Solar City. Circuit City. Yes. PWR. There we go. 10 to 20, thereabouts. These 3 weeks went from here to here pretty fast. Here it is back here. This is 5 years worth of business and weekly candles. So you can see lower highs, lower lows, but usually if they revert higher and they can break this line, the move can be tremendous. But I don't know any fundamentals on it, and technically, you know, I don't particularly have a reason to play it on the upside. But if this squeezes enough and then the bust out, so from where is the question? So you know better than me, then you can play it. Back to how I would play it from the long side. There are something called call options, obviously. Options contracts, these are bets, lottery tickets you buy. If they pan out, you get paid big. If not, you wasted your money. The good thing is they don't cost a lot. The bad thing is if it moves against you or nothing happens, you lost your money, just like a lottery ticket. So let's say I want to go to July and bet that between now and July, so 25 days, 24 days, it's going to have a big move. I don't want to buy it for $14. I'll buy the contracts to the privilege to own it if it runs through that price I'm thinking. So in this case, I probably would want to go higher outside of July. Give myself more time. How about 60 days? I don't know. You might have a different timeline. But let's go to 60 days. If I thought that in 60 days, the question is, okay, between now and 60 days, this is now, and so somewhere here, it's going to be somewhere around 20, because if it breaks this line, it's going to shoot higher. So the idea is, technically speaking, whatever reason, if it runs up and breaks this line, it might invite more buyers and technical buyers. And if they do eyeball, they should get to here and then start thinking. Why? Because this is a level, a pivot level. Look, bounce, 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 and lost it. So they're going to come back here and they can't just rip through it. They're going to have to stop and breathe unless you get a headline like you know, Circuit City. I mean, Solar City. That's twice. So you find your level and you find your timeline. I prefer closer to the money and out in time. So if 18 maybe, that sounds reasonable for somebody in 60 days. If you know something on the inside, maybe an earnings report or something. Let me see if they're pricing in any events. Looks like reports here sometime. If I analyze, yep, it reports late July. So there could be something building in. This is the nervousness of Brexit. But somewhere here it reports, so they haven't reflected that yet. But regardless, so I pick a level, I buy the calls. So let's go with 18. So if I buy that 18 call, if I do one contract, that's times 100, so $42, this gives me the right to buy 100 shares at $18, even if it's at 23. What does that mean? It means that somebody committed to buying those shares. I mean, I'm sorry. To selling me those shares at 18, even if it's at 23. I'm so used to shorting and explaining the short side. So for that privilege, I'm paying them now 43 cents per contract. Contract is for 100 shares each contract. So if I do one, that's $42 a cost. But if the stock runs through 23, I'm using 23 arbitrarily, then somebody is just lost 100, because it's 100 shares. times the difference between 18 and 23. So $500. But they only collected 42, so that wasn't a good deal for them. For me, it was a great deal. I paid 42, I made 450-ish after fees. So 10 times my money. That's the power of options. Just air math. Don't hold me to the math exactly, but that's how it works. So if I think it's going up and I don't want to risk $14 a share, 100 shares, that's $1,400. How about investing, even if I buy this one, or that one or this one, it's still, but for me to make it worth my while, I go up a little higher just so I can get more juice, because the move from here to here will make these explode. What do I mean? Like here, 8 cents, long shot. That's why it's only 8 cents, because it's a long shot. The stock basically has to almost double, eyeball maybe 40%. So for this to come to fruition, but if I buy it for 8 cents, and price spikes on a news like the Solar City news, this 8 cents will turn into dollars, and then really roll in the money. But these are long shots. Unless you know something, unless there's an event that could actually do that, then this will be a lottery ticket. Here, middle of the road, it's still a huge jump, $2-3 on a $14 stock, $15 stock. That's a big percentage, but it's doable. These are volatile stocks. So again, the concept is this is stock rising because that's the price. This is stock falling. These are puts. So if I was bearish, I'd go this side. But we're talking somebody that wants to go long SunPower. So they do that. They buy a call and cross their fingers and wait and hope that within the 60 days, price spikes. The minute it spikes, anytime during 60 days, then you can exercise their right. What happens? Let's say it jumps to $25, $23. You can monetize that profit in 2 ways. One, say, hey, you know what? I own this contract, therefore I will exercise it, put those shares into my account, take the money, which is 18 times 100, not 23 times 100. And then as soon as that happens, you turn around and sell those shares. And you pocket the difference because you only paid 18, you immediately sell them for 23. Who's taking that loss? It's the person that sold you that contract. So that's one way you can monetize it. Or if that contract turns into $1 or $1.30 or $1.02, look, they get pretty expensive. If somebody had bought the 12 and it ran through and now it's $3, so there's a lot of money to be there. You can sell the contract. You can say, hey, I've got a contract for sale. Somebody will buy it. And you can sell the contract. You only paid 40 cents and now it's worth a dollar, then you make 60 cents. You're more than doubled your money. So, sorry. I don't know what it will jump because time is of the essence. So it depends when it jumps. If it's late in the cycle, it's probably better to just exercise your right and turn around and sell the stock. If it still has a lot of time on the clock, then this will turn into bigger money, and then it may be just easier to flip the switch and sell it outright. It all depends. But that's how I would go along a stock where I don't want to buy the stock, but I want to leverage. Why would I do that? Because options move at a higher percentage than regular stocks move. What do I mean by that? Okay, let's go to GoPro. GoPro today had a 3% move up. I don't know why, don't care. I'm illustrating the point. If you owned the stock yesterday, cool. You made a cool 3% in one day. Outstanding. Well, look what happened if you'd owned the options. You made 14%. It's bigger bang for the buck. It depends on the level of risk tolerance that one has. This might be a viable alternative to actually buying the stock. So I said one contract. You could do 10 contracts, therefore spending $400 or $500 to do 10 contracts. But now we're talking 1,000 shares. So if the scenario unfolds, now the 500 turns times 10. So bigger potential loss, $500. It could disappear in an instant, because if the stock turns around and falls, this 42 turns into like 20 cents and 10 cents and 5 and 8 cents in no time. Yeah, the further you're away from current price, this is current price 15, the cheaper it is because it's less likely to happen, right? So if you buy it here, and if you buy this one and price is here and then price falls tomorrow, the distance is bigger. Now it's a lesser chance of happening, this bet, the lottery ticket, then it loses its value. It turns from 40 cents to 20 cents. So if you did 10 contracts, you lost half your money. You lost $250 in one day overnight on a headline. Conversely, you made $250 on a headline. You see what I mean? So yes, bigger bang for the buck, provided you guess correctly, but you're going to lose it anyway in real life if you bought the stock. So bigger bang for the buck. That's why I like options. You have to know what you're doing in picking the right stock, picking the right time, picking the right level. If you want more time, you click that out, you go to September. And September will probably be more expensive. This was 42 cents in the October. Why is it more expensive? There's more time on the clock. I have 88 days to be correct. So the lottery ticket, I can see the drawing on Friday, the drawing next Friday, the drawing the Friday after that, the drawing the Friday after that. So I have more chances of winning. If I go to December, it's going to be a lot more expensive, $1.22. Now we're talking, yeah? So it went from 3 times as expensive. If I go to January leap, that's next January, obviously, the 17th. $18, $1.40. See how it gets more expensive? Then I'd have to go up here to make it cheaper. So you're going to have to find a balance. July, August. If you think this is going to happen in July, then the cheapest way to do it is, here's 18, 22 cents, 23 cents. If you think it's going to happen within late July. This might include the earnings. Yep. 728. I'm not sure about exactly when the earnings, but this cuts it close. You know, they report the next day the contracts expire. So if you have any questions, let me know. Quick lesson on options, buying calls if you're bullish the stock.